I guess you've been anxiously waiting for final exam because that symbolizes the finish of a semester, a big achievement to you. But don't be overly exhilarated. Many more semesters to come. Just only one down, right? One of so many is down. Not down yet. Is to be down pretty soon. Okay. Next week, 10 minutes before the hour to the 10 minutes before the hour. 3 open-ended questions and 3 very simple calculation questions. So, nonetheless, you would like to bring in a little calculator. Maybe your smartphone will do one of the 3 questions. What do you know about the price level or the price index? As I keep saying, price level it exists only in your conception. In the real world, there is no such a thing as price level existing. Erin, these days, why do you keep being late? How far away are you from? Many stations? Oh, that's okay. Open book, cumulative. Okay, this is item number 2. The 2 promises I made it to you last week. Number 1, asset price and interest rate. And first of all, asset is in this textbook. As far as this book is concerned, we discussed a little about the asset, but in the real world, asset is another key pillars in economic thinking. Okay, asset is asset. Come to think of it, it's nothing other than store of value. Okay, so you keep store the value for the future years. All about utility, right? Economic discussion is maximum utility from the limited given resources. So our main discussion is, most of the discussions were about, have been about the supply and demand of products for current consumption, okay? Supply and demand for current consumption. So current means over a year. So our discussion is all about flow variables, but now it's going to different, is stock variable. So this is a stock. Good name, stock. You keep amassing something, you have a stock, right? A deck of stock, accumulation. But actually stock means accumulation. Historical accumulation we call stock. So asset is a stock of products over a period of time. So in a sense, so why do you store value? To give it to somebody else or for your future consumption? Future consumption, right? Not to give it to anyone else. Sometimes you stock your value for your kids. Does anyone have a kid already? No, right? Soon to have. Okay, how soon? I don't know. Jungga maybe pretty soon. Yoongyung maybe long time. I shouldn't say this. Okay. Anyway, that's your choice. Anyway, so your kids are your alter ego, right? Your 분신, alter ego. So part of you, yourself is your kids. So anyway, you are your kids. Not to give it to somebody else, right? For your consumption of yourself or your kids, or your kids of kids, or kids of kids of kids, or kids of kids of kids. Okay. Okay. Understandable? Okay. Not to throw money away. Okay. Not to let your money evaporate or anything like that. So, in a sense, asset is utility. Your future, your consumption in the waiting, not now, in the waiting. Means thinking. Then theories on asset markets are not so well developed yet, and part of which you call finance. And finance is mostly related to more or less liquid assets. There are two types of assets, right? Liquid assets, illiquid assets. So liquid assets is the main point of today's discussion. Deposit, corporate bonds, our stocks are liquid, right? Is the house liquid? No, not that liquid. Gold bullion, more liquid than house. How about this one? Artistic works. Is it liquid? Probably not. Okay, so one more time. Asset market, real estate market, theories are not well developed yet. So theories, the market is waiting for you to join as a researcher. So if you may measure in economics, theories on products are well, more or less developed, better developed than the theories of the asset markets anyway. Only one of this particular type of assets, I say, liquid assets, the financial theories are well developed, more or less well developed. So you see the College of Economics and Finance, 경금대학, 경제금융대학 you have, right? So 경제 is normally flow variables, while 금융 is about asset variable, 경제금융대학, you think in that way. Of course, your house serves two purposes. You keep this clearly in mind. Your house, residential house, serves two purposes. Number one, keep supplying you sheltering services, right? Which would you prefer? The open air or stay in sleep? Which would you prefer? Sleeping in the open air or in your house? In your house. That's what I call sheltering services. That's one thing. And secondly, house is another purpose is that you meet your family members together, enjoy your time together in the house. That's a kind of forum, meeting place is kind of. That's you services, okay, sheltering or meeting services. That's the services you enjoy from having that's flow variable. You enjoy. Sheltering and all the other being comfortable, coziness services. That's coziness is the flip side of coziness is the flip side of sheltering service, right? Anyway, you understand what I'm saying? From your house, in each year you enjoy, you draw. Okay, you take out services from the house. That's number one. Okay. Number 2 point is that. Second purpose is that you buy a house for the purpose of store of value, right? So you call it investment in your house. Do you understand the story? So gold bullion, can you enjoy any services from having a gold bullion? I do. I feel happy when I watch gold bullion. This is joke actually. Gold bullion is not. This gold ring is services. You enjoy having a ring, right? That's so to make up yourselves, right? That's a way of. So and then partly you see investment, right? Diamond ring, you have some value. So as an investment purpose, which is better? Diamond ring or gold ring? No, gold ring. Diamond is not so liquid. Diamond market is not so liquid, but gold market is highly liquid. There's particularly no gap between your selling price and buying price. But when it comes to diamond, selling price and buying price gap is pretty big. That's the typical nature of liquid or illiquid market. Liquid market, selling price and buying price is very small. That's what we call a liquid market. And then house market, selling price, buying price gap is very big, right? In that case, okay, used car is partially your investment, right? Which would you buy? Everything else being equal, Toyota Corolla or Hyundai Elantra. Same buying price and same enjoyable trade. Which would you buy? Toyota Corolla, because Toyota Corolla has higher reselling price. Do you understand? When you buy a car, that's another key point is that what is the reselling price? used car price, reselling price, the key point. Okay, so in that sense, car is partly enjoying the transportation service and partly for investment. Okay, but used car market is it's not so liquid, right? And the asset purpose is not so good. Store value purposes, buying a car is not so good because, as I say, selling price is much lower than buying price. Same car, but when it comes to gold, same price. It's a small difference. Selling a gold bullion is pretty much same. Selling price is pretty much same as gap is very small. Do you understand what I'm saying? That's a matter of liquidity. Liquid. Another example is the stock market. A stock. How big the difference between selling a stock and buying a stock? Very small, tiny. Or the brokerage fee is very small. Do you understand what I'm saying? So from this you understand liquidity of an asset could be measured by the what you call bid and ask price differential. Bid price is your selling price, and ask price is your buying price. Bid and ask is the jargon of the professionals, investment professionals. But anyway, one thing I want you to know is that you may use the price gap, okay, of an asset. Okay, so price gap means buying price and selling price as a percentage of the whole price, asset price itself. You may take it as a measure of liquidity of an asset. Do you understand what I'm saying? Okay. House market, residence house gap is very big. Stock market very small. Stock market, you buy a piece of Samsung Electronics stock, buying price and selling price pretty much the same. Do you understand what I'm saying? Okay, that's what I call the price differentials between of an asset, selling price, buying price. Okay, this is very practical analogy. No other professor will tell this story, very highly practical knowledge to you, except for me. Okay, in this regard, you have to thank me. Are you ready to thank me? This was, of course, second part is a joke, okay? The first part is I'm very serious, okay? It's very, very practical knowledge. Okay, now the asset market, a stock market as opposed to flow market. Flow market is product market, so we have two markets. Number one, product market. Number two, asset market. They are closely associated by somewhat different, okay, by much nature. So asset market is a stock market, while product market is a flow market. Flow market is that product market. You understand? I explained that, right? Product market. Okay, typical product market. We understood this one. Okay, product market. This means D&, any market actually is over a period of time, a day. Demand bought. What is bought over a particular period of time, in a day, in a month, okay, or in a year, in a decade. You need, so keep this in mind. Stock market is all. Product market is all about, okay. Then stock market, asset market is, okay, you may think of it as a stock market. Okay, and then, okay, let's discuss third item first. This little diagram down below. Okay, let's focus on house market. Okay, house market. As of now, we have how many in Korea? How many million houses to live in? Make a guess. How many do you think we have in Korea right now? Living units. Maybe 20, less than 20, right? Maybe 18 million housing units, I guess. We have right now. We have 18 million housing units here. Okay, and then each year newly built houses, its flow So newly built houses, how do we classify this item in our national accounting? Newly built houses in a year. What category of demand does it belong to? We demand, so newly built houses in a year, this is flow variable. In a year, okay, let's assuming 1 million new houses were built in this year, 2013. Okay? This is a flow variable, okay, newly built houses. So C plus I plus G. Which category does it belong to? Does it belong to? The investment. Okay, and when you buy newly built houses, it is accounted for as I, not C, because houses is to use for many decades, probably 4 to 5 decades to use. That's stock. No, counted here. So that's not the end of the full story. That's flow variable. Flow in, flow out is that demolished houses, right? Old houses for reconstruction or whatever. Old houses are numerous new houses are demolished each year. So there's a flow out, flow in, flow out. Okay, two flows, right? Flow in, flow out. So depending on the size, comparative size of flow in, flow out, the stock may increase, may decrease. Is that clear? Is the picture clear to you? Okay, so from this, what you understand is that a flow causes a change in stock. Understandable? So in general, not always. So stock markets, money is a stock, right? Money is supply, and the house is a stock, and then corporate stock, equity stock is a stock, gold bullion is a stock, diamond stock is a stock. So let's focusing on gold bullion in the world. Okay, some flow in, right? You extract new gold bullions from underground. Okay, that's inflow, flow in, flow out. Gold is for something industrial uses, right? Gold is used, so not just ornament or anything like that. Industrial uses, it disappears. Okay, so then flow in, flow out, gold bullion. You understand what I'm saying? And then money. Sometimes the government expand the money supply, right? Other times government contract money supply, flow in, flow out. Understandable? Okay. So in general, it should be bigger. Flow in a year or a stock. Okay, let's focus on the housing units. Housing units. How many houses to live in? The number of stock, as I said, maybe 18 million in Korea right now. Each year, how many are built? Maybe flow is maybe less than 1 million, right? Less than 1 million units. So from this, in general, you might think that the stock is much bigger than flow in a year. Do you know what I'm saying? Okay. The problem is that the flow variable is only traded here, newly built. Oh, no, not. Yeah, you may think in this way. As the house is the trade is, so in asset market, there's no difference between newly built market, old market. Of course, there is depreciation, but you put this depreciation aside. Then apartment is pretty much the same, right? Newly built apartment and 5-year-old apartment. Which would you choose buy? Newly built apartment or 3-year-old apartment? No, I would buy 3-year-old apartment because you can avoid all the toxic metals from the newly built formaldehyde. You see, I don't know the technical names of formaldehyde, but the headache giving smells all different. By doing that, you can avoid all those hassles, right? So 3-year-old apartment house is better than newly built apartment. because newly built apartment, you don't know what you will come across in the apartment. Nobody has tested the apartment, right? Okay, so anyway, all jokes. Then anyway, even if the small portion of the asset is traded in a market, and then price is the same thing, right? Think about it. Apartment in Seoul, the price of apartment, whether to be sold or not, whether to be traded or not, price is the same, right? But in the world, just a small portion of asset is traded in each year, right? Trade itself is a flow variable. But what I mean is that the unit traded in the market in a year is much smaller than in the although stock variables, right? But the trouble is that even if your apartment is not on the block, not to be sold, okay, then your price goes up, right? Then you feel your wealth goes up and down, right? You feel then depending on the market price of, so you feel richer or poor simply because of up and down of the price on the block is traded units, right? Do you follow what I'm saying? For example, just to give you a rough idea, let's assume there are 100 gold bullions in the world. Okay. Oh, it's only 5%. 5 is on the block traded in a year. The price is determined by in the flow market, trading market, right? But 5 units define the price of the rest of the old stock, right? So in a sense, 5 is very small portion defines the other 95% of the whole asset market, right? So in a sense, so this kind of the tail wags the dog, right? 5% defines the total asset of the prices of all the asset markets, right? So this may cause a serious problem macroscopically. Do you understand what I'm saying? Even if you don't have any intention to buy or sell new apartment, your action will be highly affected. What they do, what the tail does, highly affected. Because as price goes up and down, your wealth will go up, fluctuate, right? Your wealth goes up, you will consume more. If it falls down, you will consume less. Do you understand what I'm saying? So it's a kind of amplification of the nature of the market structure. Okay. Then there are 2 types of assets in the world. One is fixed income securities. It's a professional jargon in the finance. Fixed income securities means future price is fixed right now. Okay. So when you buy a corporate bond, is the future price fixed or not? No, fixed cash stream, future cash stream is fixed. You buy a corporate bond, future cash stream, we call income, your payment to you is fixed. When you buy a corporate bond, okay, for example, 30-year corporate bond, each year fixed amount of income will be paid to you. And at the end of the maturity, the full amount will be paid to you. So anyway, from when I buy a corporate bond, future cash stream is known to me. When you buy a public bond, same story. When you buy a public bond, government bond, future cash stream is known to you. Okay, that's what you call a fixed income security. Then, on the contrary, okay, if you buy a house, do you know the future price of your house? No. Only all that you have is some expectation, right? Certainly you have some expectation. Otherwise you wouldn't buy the house in the first place, right? So when would you buy a house, Jian? You expect future price, your house will appreciate or depreciate. In which case you buy a house. Future, your expectation about the future is that the house price will go up or go down. In which case do you buy? Go up, right? Do you understand what I'm saying? Whichever investor has a kind of expectation about the price, future price of the asset you are going to buy, right? Without the expectation, if you buy it, what do you call you? Irrational. You understand what I'm saying? So any irrational people would not buy anything if he or she doesn't have any price expectation or price appreciation the same price, right? From this, you can clearly understand each and every investor has to have an expected price of the future. Okay? Without expectation, of course you can do that. Then you will be called crazy or insane, irrational. You understand what I'm saying? So, is that clear to you? Two types of assets. One is the asset, cash flows from which is fixed right now. That's what I call fixed income securities. The other one, all that you have is expectation of a future cash flow, not the fixed income. So general assets as opposed to fixed income securities. And then you have heard of the term assets. We'll come to that shortly. Then future price is fixed. Category number one, in general, fixed income securities and something else of your imagination. Anyway, whatever you can, it's up to you. Because if you are innovative, you can develop your own product, financial product or whatever. So that's what I say. Anything else or your imagination. All others, okay? Stocks, price you never know. Houses, real estate, gold bullions, antiques. Okay, so many people buy antiques for the investment purpose. Okay, antiques, artistic works, things like that. You don't have any idea, but you have some expectation. Okay, now asset to be traded in the marketplace. You buy an asset. Remember, buy an asset for the purpose of investment. When you buy a house, you have double purpose. When you buy a house, you have double purpose. One is to live in. The other is as a purpose of investment. In which case, exclude the first one. That's a different story. So here, we buy an asset for the purpose of investment. Okay. Then to buy an asset, you make an investment in, right? Is that clear? Or more broadly say, you lend money to somebody else, right? Because the party who has gotten your money can use it. Okay, that's equivalent to lending money. To sell, okay. To sell your asset, what do you get? Money back, right? To sell an asset means whatever asset you sell, okay, you have a money, right? That's a disinvestment or borrowing. You sell something equivalent to. Is that clear? Right? Asset trade is, come to think of it, investment, disinvestment or borrowing or lending. Okay. The most typical example is deposit, bank deposit. When you buy a bank deposit, what is it? Is it the investment or disinvestment? That's investment, right? For future use, right? Deposit, you say buy a deposit. You buy a deposit. You make a deposit money with the bank. You say you can call. Okay, often you can call that you buy a deposit. You buy, that's an asset. Deposit is an asset, right? When you make a deposit, you say paper, small paper, right? You will get 통장. You will have, right? That's actually making deposit equivalent to you buy the 통장 with your money. You return the 통장, you'll get the money back, withdraw, right? Is that clear? So deposit is effectively buying an asset. Okay, so is your deposit fixed income or not variable income? You make a deposit right now. Are the future cash flows known to you or not known to you? That's known to you because when you make a deposit, the bank tells you how much will you pay back sometime in the future. So deposit is a type of fixed income securities. Is that clear to you? The meaning of fixed income or others, all the others. Okay, it's clear to you. So to buy an asset is investment or lending money. To sell asset is disinvestment or borrowing money. Okay. Then let's get back to the prehistory era. Even in the prehistory era, even I guess even in the Garden of Eden, there was borrowing and lending. At that time, there were only two people, right? Probably no borrowing, no lending. So ever since in the a society of multiple people, okay, then probably there was borrowing some money, right? Okay. Borrowing some money, when you borrow from, this is very early in the history, human history, in the history when financial market were not well developed as they are now, okay. Prehistory era, financial market is underdeveloped, okay. What do you do in that time? You need money, some money. Money may be the shells or what dotori or what, I don't know. Money. When you borrow money, what do? You made a contract, right? Okay. Affidavit. Okay. You make a pledge. So I borrow some money from YG. Okay. Then I say, okay, I certificate. I duly borrowed such and such money from YG, and I promise to return to her with some interest, and then on such and such date. Okay, believe me, I keep my promise to you too. To you. So that type of note, I make some certification, right? In a note, a piece of paper like this, right? What do you call that? That's what you call IOU. In the Korean language, IOU is 자용증. Okay, Korean language 자용증. IOU, English IOU. So pronunciation is the same as IOU, right? IOU, that's the song. So, okay, this is the hyperlink. I'm very serious. Okay, IOU, even if so imitating the pronunciation, we normally say I owe you some money. I owe you. Okay, this is 자용증 in English. So normally 자용증 is valid between YG and me. Okay, but as time goes by, people devised a new way. Have devised a new way is that. Okay, assuming duration is maturity is a year from now, nobody knows. She doesn't know. She doesn't have any idea. YG doesn't have any idea what's going to happen in the midway. She may get married, unexpected marriage, right? She needs money, right? She wants the money reimbursed, or you call it reimbursed, right? Reimbursed from me. She wants me to pay the money back to you, but she doesn't have the right to require it of me, because my promise is that 1 year later okay. Then if she wants money back, so I may be counter propose. So if you going to reduce the originally, let's say the money was I borrowed 100 million won from YG, and then the plus 10% interest. In the midway, she wants the money back from me. Then my proposal is that, if you are ready to take only 95 million won, I'll pay it back to you. I'm going to give her penalty, right? Unless I don't have any obligation to pay the money back, right? I don't have any obligation. So only from goodwill, okay? I pay money back, please, if you want only, let's say, 90 million won from me. I pay the money back. So that's a penalty to you, right? Then the instrument is that we make a new invention is that we make the IOU transferable to somebody else. Transferable means it's valid. If somebody YH buys instrument from her, that's IOU, right? And then she has the right to get paid back from me on the maturity, the given amount, 100 million plus 10% interest. I have to do that. That's required thing by the law. Do you understand what I'm saying? That's the transferability. So that's what we call securitization. Security is to transfer, freely trade between third parties. So beginning, there are two people, only two people, me and YG. All the others are third party. And then originally IOU, original form, third party doesn't have any right to call the money from me. We call call. Call meaning I want the money back. Okay. Third parties in the beginning. So originally IOU, non-transfer IOU, third parties don't have any claim to me. Understandable? Now by making it transferable, any third party who owns it, any third party who owns the IOU has claim to me on the maturity, not in the midway. So now, fortunately, YH or Hyunji or Yerin or Dongyun or Jaehyun or some have intention to have some extra money to invest 6 months to come. For example, my borrowing from her was 1 year, right? For the 1 year, 12 months. And midway, she needs the money back. Okay, I don't have the obligation to pay the money back to YG. Okay, then she doesn't have any claim from me. But fortunately, there is a secondary market well developed. She can easily find another person, third party, who are pleased to make a 6-month investment. It's clear to you? Then freely transfer. That's what we call securitization. Probably you have heard of mortgage-backed securities. Mortgage-backed securities is that as a bank, they lend to a newlyweds for 40 years. That's mortgage. Mortgage is very, very long-term with the house as the collateral, okay, the land. Then the bank has to wait 40 years, right, to get fully paid back. Sometimes in the midst, nobody knows, right, in the midway what's going to happen. Then the securitized mortgage-backed thing is that it's transferable to any investors. That's what you call mortgage-backed securities. Do you understand? Okay. You don't need to clearly understand that. It's enough to have some rough idea what I'm explaining right now to you. You have now some rough idea, right? You have some now understand the name of securitization and mortgage-backed securities, things like that. Okay. So this is the case. Initially, IOU, okay, lending and borrowing and lending started from very simple form of IOU, 자용증, which were not transferable between third parties. And then somehow people came up a new bright idea, which is to make non-transferable things into securities. Is it clear to you? So now, remember, IOU income was fixed, right? Okay, when I make a promise to YG, my payback cash streams were fixed, right? That's what I call fixed income securities. Okay? Understandable? So because of this, most securities, debt securities are fixed income. Debt securities are different from equity security is stock. Stock is there. Understandable? So anyway, there are two types of assets. One is fixed income securities and the other general assets, fluctuation assets with fluctuating prices. Okay, now this is the situation. So now main essence of my story to you in the first hour is the price of an asset. Okay, so price of asset. YG buys my IOU from what? 100 million won, right? That's the price right now. So a security or an asset, you have to pay the price right now, right? Current price is P here. P, what is P? Your investment right now, right? You buy a gold bullion, you have to pay the price, current price, right? That's your investment. Is that clear? The current price of an asset is your investment right now. You buy a house, okay? So 1 billion won. Okay. 1 billion is, can you buy a unit of palace, Tower Palace at 1 billion won? Probably not. I'm not so well aware of the Tower Palace. Are you? Okay, I shouldn't ask this type of question. So anyway, you buy 1 unit of Tower Palace at 2 billion won. That's your investment right now, right? Is it clear? This is one key point. The current price of an asset is your investment. Is it understandable? Remember, asset we say excluding the living purpose. Okay, investment purpose, you buy something, gold bullion, or government bond, or whatever, gold bullion, artistic works, or anything. Okay. Keep this in mind. P is nothing other than your investment right now. Okay. Then if you understand this very clearly, okay, so you are almost ready to understand the full story. So now, probably the most generic name is ROI, return on investment, ROI. And then it has many different forms, or it is called many different names. Okay? ROI may be the most generic name, return on investment. So return is you get something extra. Okay, so when you pay, you buy, when YG buys from me a piece of paper at 100 million won, she expects some extra, right? Not just 100 million plus 10 million won, that's extra, right? That's return. A return ratio. Return is always in terms of a ratio, not money. So that's what we call return. Okay. Return on, well, simply return, more precisely, return on investment may be the most generic name for what you get extra to, in addition to your original investment. Okay. Original investment is, of course, P, the buy. Okay, understandable. So many names: interest rate, yield, and then many things. Probably you have heard of ROA, ROE, RRR, IRR, many different names, things like that. So two key names I want you to remember at this point of time is ROI and interest rate. Okay. Interest rate is normally for certain type of financial instrument, such as deposit or things like that. Then that's very easy now. Okay, your purchase price P today, your investment today. Okay, you plan in sell it in N years later, not now, because by definition, investment is for sometime in the future, right? Not today. Okay. Okay, so N year to generalize the story. Two different cases. One is fixed income securities F, or you have expected fixed income in the future, FE. Right? So principle is the same, only difference is that one is F is fixed, the other F is variable. But anyway, nonetheless, you have to have an expectation about the F. Without expectation, don't do that. Otherwise, you will be called crazy. Okay? Is that clear? Is that clear to your mind? Any investor to have future numbers, F fixed or FE. Fixed number or expected numbers. Fixed number F. Expected number FE. Is that clear? Okay. So now we are almost there. So calculation of ROI or interest rate, the interest rate. You can easily understand here. F or FE. If you buy a fixed income security, this is F. Okay. If this is not FE, in either case, okay. This is calculation, the way how you calculate ROI or interest rate. Is everyone comfortable with this equation? Okay, let's take the fixed income case, for example. So fixed income, you know the future cash flow, okay, any years later, okay. This is, so the calculation 1 plus I and P. This is how you calculate the interest rate. Am I right? Hello, am I right? Are you comfortable with this equation? This is how you calculate interest rate. N, that's an N year later. Sorry, N year later. Is that clear to you? N year later. If M year later, that's M. It's up to you. K years later, that's K. J years later, that's J. You can attach any number. Okay. I'll give you, okay, 1 minute to digest this. This is actually definition of ROI. You define it in this way. Always our calculation is N is, that's what I call compounding. Okay. For example, okay, you deposit 1 million won for 2 years. There's 1 million won, 2 years at the interest rate of 10%. How much money will you get in 2 years hence? Okay, the total money you will get in 2 years from now is this one. Calculation should be always compounding. 1 plus 0, 1, this is 10%, right? 2 years. You calculate in this way. That's what I call compounding. Interest calculation should be always in this way, compounding. Okay. Same story. So you assume you investment this much money, right? P right now. Right? P right now. Right now. Okay. You expect interest I. Same story. N is 2 years here. N has become 2. Same relationship, right? What you see in the real world is this one. Just nothing other than generalization of the story. So I'll give you, okay, half a second. 창현, you're with me, right? Not to mention 병윤. 병윤, do you understand this? Are you sure? 동균. You're comfortable with this, right? 성철 may or may not be comfortable. 원정, when did you sleep in? When did you come in? 9, 10? Okay. Compounding, this is compounding. That's compounding. 복리계산 in the Korean language. Okay. 복리계산 is compounding. Each and every industry is now calculation always compounding. Not this one. In the past, maybe in the Garden of Eden, calculation was something like you calculation this one. 1 plus 0.1 multiplied n here. So this is okay. It is not irrelevant. We don't do this way anymore. Sometime in the future we did this one, but all these calculation is this one. That's compounding. Okay, is it clear? Then the rest is peanut, right? You can solve this equation. So you tell me how to solve this equation. In terms of, you are interested in I, right? To find I. Mingi, you tell me. You solve this I. Songyun. It's very easy. That's what you learned. You kept doing in preparation of college entrance exam. That's what you did. That's very simple. Songjun, you tell me. Soyoung. The answer is there. Okay. Sanghyun, you tell me. Move this, right? That's that easy. It's very easy, right? Isn't that easy? Gyun, that's peanut, right? That's Colombian egg. You know how to. You know the answer. That's very easy, right? Okay. Is everyone comfortable with this equation? Gyun, Mingi, there's no magic here. You see, turn this around, then put this easy. Mingyu, even Mingyu, he understands this. Mingi, you have to, you know this, right? Sanghyun, there's no magic, very simple. Hyunung, right? Very simple. This is easy. So, what is this? It is up to you. Okay. ROI or interest rate or whatever. Okay. I is interest rate, right? What is P? It's a fixed income. This is fixed. Right? N is fixed. If this is not fixed, PE anyway, you have an expectation E. Right? P, what is P? What is P? It's a current price, right? So price of an asset. So from this, you see, when price of an asset goes up, I goes up or goes down? Goes down. How easy that is. Okay? Is that clear to you, Byung-yun? What is P? One more time, Byung-yun. What is P? The price of an asset of your interest right now, right? Right? P, current price. This is your calculation of interest, okay? P goes up, I falls down. Right? Is it clear? That's that easy. So the same story actually. Asset price goes up is the same as interest rate falls down. Same story. So here, one last message to you is that near the top of page 2, bottom line, the interest rate should be the same across asset markets due to the low bond price. Do you understand what I mean? Okay, so deposit, stock market, every year the interest should be the same. That's conceptually, of course. There are many different transaction costs and then entry barrier, things like that. But conceptually, all prices also. So bond price falls down, your deposit price fall down, your borrowing price will fall down. All price move, interest move, should move in the same direction at least. Okay. If they are not all totally the same. Is that understandable to you? Okay, so this is very, very practical knowledge. Nobody else will tell you. Nobody else except for me will tell you. Believe me. Why? Once I said why is actually real economy means quantity, but in the real world, there is no way to sum of different products up. For example, simple example, this year, Korea produced, let me check. I think I missed someone. Shin Sung-wook, really? I didn't call your name, right? Maybe, okay. You are Park Seo? Late. Jin Sung, late. En Kang Galan, didn't come. Owen Chang doesn't come. Donggyun, late. I'm sorry.
I'm late.
You're late, Donggyun?
No.
On time?
Yeah, out there.
Was he on time? No. Okay. Okay. I'll count on you. Sanghwa, Isangwa, on his way. But anyway, it's Ungun. So real economy is conceptually in terms of quantity. For example, this year Korea produces only one apple and one orange. So in total, so what is the Korea's GDP? One apple plus one orange. Now, what if there are millions of items? You will say one orange is three apple and five coffees, and you keep saying that until you are dead. So you still you are not done. Still you are not done. So we assume the base year, 2013 is base year. We assume market price represents the real value of the thing. Okay? For example, 300 on apple, 500 on orange. What is the GDP? 800. 800, what is GDP? This year's GDP. Okay, base year. The following year. Okay, so if Korea produces two apples and two oranges, okay, what is the real GDP? That's 16, right? 16, twice as much, right? Twice as many. Previously, I say we assumed 2013 was the base year. Base year, we assume the price, each price represents its real value, true value. So one apple is, the value of one apple is how much? 300. Okay. The value of one orange is how much? 500. The following year, 2013, Korea's GDP was one apple plus one orange is 800. So the common unit of metric is money. Okay, money. So you describe everything transform everything into money, then you can sum them up. Money is money. One is one everywhere, right? The following year, what is GDP? 2014, two apples and two oranges. What is GDP? 1600, right? Is it clear? Because so if 2014, 13 was 800, the following year should be 1600, right? The following year's real GDP is 1600. Dayan, are you with me? Are you sure? Sanghwa, he's not sure because he just arrived. Understandable? Okay, that's real GDP. But unfortunately, the following year, the prices keeps changing, right? Then you value, okay? You value the current price at that time, 2014. That's nominal GDP. Okay? Somehow price goes up. Okay, so apple price remains the same while the orange price goes to 600. Then what is the nominal GDP the following year? Maybe probably 1800. Okay, right? 1800. Nominal GDP 2014 is that two apples 300 each. Okay, and then two oranges 600 each. Right? How much? 1800. That's what I said. Right? Okay. Understandable. So what is the GDP deflator? It's very easy, right? GDP deflator is let's say 16. Okay, to 1125, something like that. 1125. How do you calculate that? GDP deflator is there 16, 18. This is GDP deflator. That is very easy. That's that easy. This is GDP deflator. Huh? So is the concept clear to you? That's the key point here. So even if nominal real GDP is to represent the quantity terms, but there's no way to sum them up. So for our convenience, we unify the metric is in money term. That's why it's money term in base here. Here we assume is that it's big assumption is that it's very strong assumption. Okay. Price level is not, no, you don't need any assumption, but price level, no way to define price level. And very strong assumption is that we assume in the base year, the market price represented true values of all the things. Okay, so, okay. Then the figure 1, this is a great question from Hyunji, is the figure 1, chapter 33. It's historical real GDP. That means, okay, base is the same. Keep this in mind. It's even if it covers how many years from, okay, many decades, right? All through the years, the base is the same. Okay, if base years are different, you are effectively comparing orange to an apple, which is nonsense. Okay, is that clear to you? Okay. Okay, thank you, Hyunji, for that particular. That's really great question. Okay, so today's quick review of chapter 33 and then brief introduction to chapter 34. Remember, this is the second from the last meeting, okay? Like a regular meeting, I mean, except for, bless you, except for what you've been expecting to final exam. Okay, so review ASAD model, quick review of ASAD model. Then figure 3, this one is AD is downward sloping, right? Downward sloping. Why is that? Why? Equals C plus I plus G plus, okay, and X. Okay. So this is discretional variable. You know, government at the mind of the boss, your ultimate boss or big brother or whatever. So that's big brother's discretion. They up to them. No relation to P or anything. Then remaining 3, 1, okay, this one. So explanation is 3 ways. One is price level goes up. Okay, what happens to you? You have money balance, right? So collectively you cannot change the money balance. It's given to you. The money is dumped upon the public by the government. Okay, when price goes up, okay, your value of money, purchase power declines, right? Okay, so your wealth declines. Would you buy more or less? You will less. So I say textbook explanation is the other way. My explanation right now is this way. Try to stick to the textbook, not to confuse you. Okay, let's assume to match the textbook. Assume the price falls down. Price falls down. So you have this much money. The public has this much money. The purchasing power of this goes up. Your wealth goes up. Okay, it's money, right? Money is a type of asset, actually. Remember, money works as a store of value, right? You store money underneath your matrix. That's a store of value. That's your asset. So price goes up, asset value falls down. You are become less wealthier than otherwise, right? So if you are less wealthier, would you buy more, consume more or less? Less. I explained it the other way. Price falls down, your wealth goes up. So you consume more or less? more. You move this direction. Okay. So price falls down, you move this direction. Okay. Price falls down, you move this direction. Price falls down, moving this direction, right? Consumption Y goes this way. This one element of Y goes this direction. This is main topic of this week. Anyway, for now, Ungan, when did you come in? 2 hours ago? 2 hours ago? An hour ago? 10 minutes ago? So, 다은, shall I check 2 of your neighbors in? Okay. 다은 is very generous. As generous as she looks. Okay. So, is the thing is pretty much same story. Okay. This story is that price falls down, you have this much money, right? Price falls down, do you have more money and less money than you need? More money. So, because you have more money, don't burn it. Okay. Buy assets. So you have 2 choices, right? When you have extra money, one is buy products or buy assets. Okay. When you buy products, what happens to you? Price goes up. Okay. When you have buy assets, interest falls down, right? Why that is that's what I explained in the first hour, right? When you buy assets, the price of asset goes up, goes down. Same story. Remember, we have 2 options. One is when you have extra money, okay, you feel, okay, you realize you have extra money 2 ways, okay, to dispose it. One is to buy products, more products, or to buy more assets. In either case, product price goes up, that's P goes up. Okay, asset price goes up, interest falls down. Is that clear? That's what I explained in the first hour today. Is that clear? When you have extra money, you have 2 options. One is buy more products or buy more assets. If you buy more products, P goes up. Okay. When you buy, P is normally P stands for, in economic text, P stands for price of products, not the asset. Okay, not the asset. So P goes up. That's product market. P. Okay. The other one, you buy more asset. Asset price goes up, right? Asset price goes up means what, Yu-jung? It's the same thing as. How did you know that? Even without being here. She wasn't here in the first hour, right?
No, I was here in the first hour.
Oh, really? Understandable? Okay. I falls down, what happens? Little I goes up, goes down, big I goes up. It's ironical, right? Little I goes down, big I goes up. On the NX, okay. So price falls down, R falls down, you will invest abroad because domestic price is lower than foreign price, right? As you buy, invest in the world market, domestic currency depreciates. Then you will be more competitive in export. Export will increase. So understood. And the other one is there. About this is figure 6. About the sloping. Okay. Sticky wage theory. Sticky wage theory is there. Okay. So everything else being equal. Okay. So your product price goes up, while wage remains the same. Price goes up. Price cost remain the same. Would you produce more or less? Sticky wages theory. Okay. Everything is proportional. You don't need to change anything. All prices doubled. All prices double. You don't need to change your behavior. Okay. Is it understandable? Because effectively it doesn't change anything at all. But here, sticky wage is that even if your price goes up, wage remains the same. Would you produce more or less? Absolutely more. What I mean is that you are here. This is your what you this one MPC. This is market price. This is right. Everything doubles. You wouldn't change anything at all. Okay. Why there is here? This doubles, right? Here. This doubles here. The same quantity, the same story, right? Is that clear? You are here. Okay. Sumin is a rational form. Sumin. Are you not? Oh, Sumin is rational. Q. Price. Because this is your MPC. Okay. The market price is P. 0. How much would you produce? Q0. Okay. This you produce, right? Q0. Right? This remember this is from the supply curve, right? Yujong, am I right? This is it, right? So now all price doubles. All price is double. All price double. So P0 becomes 2P0, right? 2P0. 2P0 here. All prices means your factor cost, everything doubles. Okay? This will be shifted where? This will be go up. Everything doubles. This is double. Everything double, right? Then your production quantity the same thing. Is it clear to you? Are you with me in this regard? Everything doubles. Okay? You shouldn't change your behavior. So, do you understand what I'm saying? 기혼. 기혼이 is, you are 기혼, that's 기형. Okay, it's confusing. Looks similar, right? glasses, narrow chin. One more time. Everything doubles. You don't need to change your behavior. Change means the same quantity. Am I right? The thing is that your price doubles, but this is less than doubles here. So would you buy more or less? Produce more or less? More. That's the way you have to go. Is that clear to you? You did, right? You understand? So when Nerin was sitting here, she was always the first to understand. Now sitting there, she is the third to understand. First, second, third. Okay. Where are you now? Oh, sticky price theory is that your prices are sticky. You are selling offering prices sticky, but others are. So you are selling lower price than you are right. Is that clear? So would you sell more or less? You are offering at the lower price than your competitors. 동균, you tell us. So all your competitors' price is double. Your price remains the same because you are sticky. Would you sell more or less? More. He is right, I guess, by chance. That's what I call by luck. Okay, in the you see the essay, the Eugene Fama story. That's what I mean, luck, by chance. Okay, then misconception is pretty much the same story. So all in all, this equation. But let's focus on the third line, page 3. We have only 20 minutes today. Okay, so I think still we can finish the story. Key point is there. Okay, you follow me. S short run AS curve, the quantity you are going to supply, okay, all of you collectively. Short run AS curve, natural rate of output, this one. Okay, this is supply. y is 0. Natural rate of output is, of course, okay, the output with natural rate of unemployment. As I keep saying, practically, the economy, any economy cannot reduce the unemployment rate to absolute 0 because of what? 현민, Korean economy cannot reduce. Don't be scared. When I approach here, don't be scared. 현민, it's your turn. Okay, why can Korean economy not reduce unemployment rate to absolute 0? Okay, Sungwon, you are the most dangerous situation. What is it? Mingi? And structural unemployment, two of them. So natural rate of unemployment. Okay, so this was here. Okay, as always, we start from the equilibrium. We are assuming here, P0, here. So, okay, people learn something from the history, right? History means we expect the same thing to happen in the future. Okay, very simplistic. So this is the equation. So natural rate of output. Okay, this is GDP. Okay. Actual price goes up higher than expected price level. Would you produce more or less? Forget everything else. You come to the market, you find out actual price is higher than you expected. Expected with which you have made your business plan at the startup, right? Okay. Then what would you do? Would you produce more or less? Price is better than you, right? Simply, all in all, understandable, and that is it. So now, then this one. So A, D, A, S. Yeah. Okay, everybody happy here. Huh? And now, what is this? Okay, yeah. Near the top of page 3, a recession to the insufficient demand. Insufficient demand means, of course, this is Y0, full natural rate of unemployment, not 0. This is America, this is supposed to be 6%. Korea maybe 20.5%. Something like this. This is regarded. Nobody knows that for sure, but in general, America a little higher than this one because of recession. 6.5% is believed to be natural rate of unemployment. Korea maybe, I don't know, but 3%, let's call it. Yeah. So we start here. Now somehow, yes, how is a typical example. Stock market crash. Would you consume more or less? Same price, like at the same price, will you consume more or less? You less, right? Stock market crash, will you invest more or less? Less probably. Okay. Then what happens? This shifts here, right? So this is it. So what do we have? Y1, P1. Okay. We have, this was a typical depression. Oh, no, recession. Okay. Recession means we move here, right? And we have more unemployment than natural. The price is low. There's a typical recession. Okay. Then here there are two approaches to handle this, to manage this situation. Another one is outbreak of war. Outbreak of war is slightly different. Outbreak of war, what happens here? This declines, CI declines, but T goes up, typically, right? War, think about the war goes up. So which is bigger? We don't know. You need additional information. So anyway, typical recession. Then two things is the adjustment in the long run. You are here. You are here initially. We have recession, right? In the long run, you'll be moved this direction. Why do we move to this direction? Everything, price falls down because you have extra capacity. What would you do? Would you keep yourself, first of all, you are fired. This many people are fired, okay? People. So if you are fired, which you wouldn't have in the future, but simply assume, okay? Not you, okay? Your neighbor, not you, because you wouldn't be fired, no matter what. So your neighbor gets fired. Would he stay calm, stay home, idle, or would he actively seek another job? Seek another job, right? By reducing wage down. Okay? So or some other producers have unsold product. Then would they discard, throw that away, or bid the price down to sell more? Bid price down to sell more, right? Wage down, price down, this falls down. So we will go in this direction. Here, eventually here. Okay? So in the long run, price falls down and then full employment. Okay? Now everybody is happy. Your friends, luckily, fortunately, your friends, all Yoongyung's friends now can be rehired back, right? Okay? Oh, this is it. But Keynes just comes up and say, oh, in the long run, we are all dead. Okay? You are right. Okay, you are absolutely right. But okay, so I don't have such patience to wait for 2 years. Then government has to intervene. Okay, then simply push it back. Remember, this falls down, this falls down. Okay, just Wharton case. If this is 0.5, the government may add up one. Then same story, right? The same story. So this puts it back here. This is the case of recession due to demand shock. It can move this direction too, this direction. Here, we have temporarily overproduction at the higher price. Now, this cannot continue forever. So this goes up here, we'll end up here. That's demand shock. Okay, now, pretty much same story, okay, supply shock. Typical case is that when you say shock means, in general, we mean unfortunate thing, unhappy things, sad things like decrease. Then supply shock the other way is okay, this one, AD. Yes, the most typical supply shock is the oil crisis. Oil is raw material for many products. Right? This is from oil. This is from everything is from oil. This is paint is from oil anyway. The paint is from oil. If can is not from oil, drinking is not from oil. Is this from what you think is from? Okay, do you understand what I'm saying? Okay, what she wears, Sumini wears, I mean glasses and your blouses and your decorations, everything is from, even her lipstick is from oil. All price goes up, right? So, same product, what happens to this one? Same product. This shifts, right? Oil shock. That's what I call supply shock. AS does. Here, what do we have? Here, this is unemployment, right? This is inflation. So that's what I call stagflation. Okay. Stagflation is the typical consequence of an oil shock is stagflation. Stagflation is the inflation and stagnation. Here, story is the same thing. Okay. So this will push it back down here. Long run, no problem. But according to Keynes, in the long run, what? Yerin said, in the long run. That's too much. I'll slowly die better than beheaded. Then the government steps in is here. Government increase this one. Okay. Then what do we have? Same level, much higher. The consequence is very different. Okay. Here, in the long run, here supply shock return to the original position, but government intervenes higher price. All these higher price. Okay. This one, okay, here, originally here, right? Okay. Then you wait. You have enough patients will return here much lower price. Equilibrium at a lower price. The government pushes at the original position. Okay. So some differences in consequences. Okay, is that clear? So this one. So you have 10 minutes. Okay, finally, understandable, right? Very easy. Okay, not that difficult to understand. So we'll come back to this, pretty much same story in more detail on Wednesday. Basic nature is if you understand what I said right now. So the key point Wednesday is how to shift this. For all the government can do is this one, moving AD back and forth. Okay, back and forth. That's government. All that government doesn't have it here. AD, of course, government may affect AS2 by reducing production cost or increasing production cost. There are some ways, but that's very special, not general. In general, so either case, recession due to demand shock. This is recession due to supply shock. In either case, or no, in general, all that government can do is to manage AD. Okay? There are, in general, two ways to do that. One is fiscal policy, the other is monetary policy. Two policies, so putting it differently. How to shift. This covers back to original position. That's how to. Okay? Today, we discussed what for the government to do. Okay? That's today. By doing this, government, then the how to is you have to wait until Wednesday. Now, so in preparation of Wednesday, now let's get back to the page 4 of today's class note. Okay, monetary and fiscal policy. So ends and means, keep this in mind very clearly. So you have to have 3 means to achieve 3 goals. Just like you need when you have simultaneous equations, 연립방정식. So to find out 3 variables, how many equations did you need? 3, right? 3. Okay. 3 unknown variables, you need 3 equations. 2 unknown variables, you need 2 equations. 5 unknown variables, 5 unknown variables, how many equations do you have to have? 4? 6? According to Ungan, you need 4 equations when you have 5 unknown variables. Is it correct? Oh, let's boo her. Boo. Okay. So likewise, keep this in mind. To achieve 3 goals, you need 3 means. Okay, 3 goals, as I keep saying, price stability, employment stability, and BOP stability. You need fiscal policy, monetary policy, and FX intervention. As a part of your common sense, keep this in mind. Okay, policy authorities is the monetary is the central bank. Okay. Full responsibility of the central bank. Okay. 한국은행법 okay, article number 1 on the BOK Act number 1. BOK's job is to stabilize the price of our price everywhere. The same story. And the fiscal policy is either the treasury. Treasury is 재무부. Okay? That's branch of part of the government. Okay? And the Congress is totally different story. I explained this before. Tax should come, any tax, increase, decrease, should come through the Congress. The government cannot do that. So tax policy, T is to the Congress, while G is to the general Minister of Finance. America they call Treasury. FX intervention, foreign exchange market intervention, decision is the Treasury, but execution is the central bank. Why there is central bank is the only government agency which has the tools to intervene in the foreign exchange market. Okay, now we are almost there. Now, theory of liquidity preference. Okay, the name coming from everything else being equal, I prefer liquidity. That's liquidity preference theory. But as you understand, very rarely everything else is equal, right? 같은 값의 다홍 치마. Okay, 치마 prices, skirt prices are rarely equal, right? Same price, red skirt. 같은 값의 다홍 치마. But so our price is the same on the basis of your own opinion. Red skirt or orange skirt, which is expensive? Red skirt is expensive, okay. Do you understand what I'm saying? Everything else being equal, I prefer liquidity. Right? That's a good story, but in general, everything is not equal. Interest, there is interest. Okay? That's the implication of the name. Then theory is there now. Actually, this is the key thing in chapter 34. Money is not neutral because money goes up, money supply increases, interest falls down. As interest falls down, okay, investment goes up, Y goes up. So now money matters. Key point is that is J.M. Keynes' greatest contribution to the economic theories is that money matters now. Matters means money affects the real variables. So money, according to quantity of money, GDP may go up, go down. Okay. So here I explain. Okay, there are three routes. Okay, to this one P affects Y. Three routes. One is C, I, and X. Then the key thing is this channel is the key. This route is the key. Let's make you say this one. So we will focus on this fact. Okay. Interest rate I, P, R, this one chain. P, price level, and then interest rate, small interest, and then big interest investment, and Y. Main focus here. Before that, now our here market is, we are monetary market. Okay, monetary market is one of the most typical, what? You fill the blank, Song, you fill the blank. Money market, Song, the money market is one of the most typical, what? Asset markets. Okay, money market is, so one of the most typical asset market is money market. Then money supply, money demand. Okay, money demand is difficult to understand. So not difficult, but complicated, somewhat complex. But money supply is very easy, right? Okay, who has the key to the sole key to the MS? Firms, households, or government? The government, okay. Government unilaterally, the power, full power to define this one. So this is simply, okay, you are exactly on time. How money is defined, you understand. By now, you are comfortable with this case. Money is defined by 1/r multiplied by H is high powered money or monetary base. What is R? Okay, reserve requirement ratio. R is requirement. So 1 over R, what do we call this? 서정, what do we call 1 over R? 지안, what is the name for 1 over R? 1 over R. 명철. 현정. 준영. 준영's neighbor. What's your name? 준영's neighbor. 네? What did he say? I cannot hear you. 천우. Are you a student in my class? No wonder. So anyway, 1 over R is the monetary multiplier. 1 over R is the monetary multiplier. Okay, high-powered money is this one. I explained this, right? Public bonds, loans, commercial banks, foreign exchange reserves. So when central bank buys public bonds, what happens? H goes up. Okay. Loans to commercial banks, H goes up. Okay. When Bank of Korea intervenes in the foreign exchange market and buy US dollars, H goes up. That's all we studied. Okay. So this is it for today. So any questions? Any concerns regarding anything? Midterm, no, final exam is clear to you? Okay, so this is it. Have a great week.